Williams%R is a deceptively simple momentum oscillator built by Larry Williams in 1973. It measures where the current close sits inside the recent high-low range, on an inverted scale from 0 to -100. Unlike the RSI, it reacts almost instantly to price thrusts, which makes it one of the fastest readouts of short-term exhaustion and breakout strength you can put on a chart. The math is straightforward. Take the highest high over your lookback, usually 14 periods, subtract the current close, then divide by the highest high minus the lowest low, and multiply by -100. A reading of 0 means the close printed at the very top of the range. -100 means it closed at the absolute low. So Williams%R is essentially a stochastic K-line, flipped upside down and unsmoothed. Conventional zones place overbought above -20 and oversold below -80. The middle band around -50 acts like a momentum equilibrium. But treat these as context, not signals. Because the formula is unsmoothed, %R can slam from -10 to -90 in a handful of bars, which is exactly what you want when hunting fast reversals, but punishing if you trade every touch. The cleanest classical signal is the failure swing. In an oversold print, watch for %R to push below -80, rally back above, pull down, and fail to make a new low before breaking the prior swing high in the oscillator. That second higher trough confirms buyers stepped in earlier than sellers expected. Mirror this for overbought failure swings near the -20 line. Here is the trap. In a strong uptrend, Williams%R can sit pinned above -20 for days. Shorting every overbought touch will bleed you. Larry Williams himself flipped the logic for trends. In an established up move, an overbought %R is confirmation of strength, and the buyable signal is a pullback into -80 followed by a thrust back above -50. The oscillator's role changes with regime. Because %R is so responsive, divergence shows up early. Bearish divergence is price printing a higher high while %R rolls over with a lower peak that fails to retag -20. Bullish divergence is the inverse near -80. Treat these as warnings, not triggers. Wait for a structural confirmation, a break of a micro swing, or a candle close back through the -50 midline before acting. On this synthetic chart, price grinds lower into a capitulation low. %R pins at -95, then on the next swing low price prints a fresh low, but %R only reaches -82. That is hidden absorption. The entry trigger comes when %R closes back above -50, with the stop tucked under the divergence low and the first target at the prior swing high. Here is Apple on the daily for the past year. Notice how during the steady advance, Williams %R parks above -20 for weeks at a time. The actionable continuation entries are not the overbought touches, but the dips to -80 during pullbacks that immediately snap back. Late in the chart, watch where %R fails to confirm a new high. That early bearish divergence preceded a multi-week correction. Williams %R is mathematically unsmoothed, which is its gift and its curse. In choppy, low volatility tape, it whips between extremes, generating constant false signals. It is also bounded, meaning once it pins at 0 or -100, it gives no information about how much further trend can run. And like all range-based oscillators, it is blind to volume and to the absolute size of the move. Pair Williams %R with a trend filter and a volume confirmation. A 200-period moving average tells you which side of the regime to trade. ADX above 20 confirms there is a trend worth respecting. On Bollinger Band touches, an oversold %R near the lower band that also shows a money flow uptick is a far higher probability setup than %R alone. Stack independent signals, do not double count momentum tools. The default is 14 periods, but match the lookback to your holding period. Day traders often drop to 7 or 9 for sharper reads on 5-minute charts. Swing traders may push to 21 or 28 to filter noise. Shorter lookbacks generate more signals and more whipsaws. Longer lookbacks lag but cleaner. Backtest on your specific instrument and time frame before committing capital. 3 traps to avoid. 1. Fading every overbought print in a trending market. 2. Treating the -50 cross as a standalone signal without structure or volume. 3. Stacking %R with the stochastic oscillator and calling it confirmation. They are nearly identical formulas, so you are just amplifying the same noise. Use truly independent inputs, price structure, volume, and volatility, alongside %R. Tomorrow, open your favorite ticker and add Williams %R with a 14-period lookback. First, identify regime with a long moving average. In trends, hunt pullbacks to the opposite extreme. In ranges, fade the extremes with failure swings. Always demand a confirmation, either a midline cross, structure break, or volume thrust. Track outcomes for 30 trades before judging. This is education, not financial advice. Trade your plan, manage your risk. If this helped, do me a favor. Hit the like button, subscribe, and tap the bell so you don't miss the next one. See you in the next video.